Well, hello. Welcome to the OneAZ Wealth webinar on succession planning for small and family-owned businesses. My name's Tom Mitchell, and I have the honor of leading the OneAZ Wealth Management team of advisors located here at the OneAZ Credit Union. Our full-time staff of advisors are assisting clients and members of the credit union all over the great state of Arizona. We're very excited to bring you these educational events and topics to you, because it's you who share what topics you want us to present on. We present on a lot of topics this past year. We have one more webinar planned for 2023 here, and that's going to be on December the 14th. We're going to do a webinar on Social Security. It's a very popular topic, lots of interest in it always. So if you're interested, please be on the lookout for that webinar and register for it. It's going to be on December the 14th. And I think we're going to do two of those, one at noon and one at 5 o'clock again. We will be doing another webinar in the spring on business for business owners. So those that are on the call tonight or the webinar, I want you to know we're paying more close attention to some of your interests and your needs. There's an act that was passed, the Secure 2.0 Act that was passed, and there is more ramifications that will be affecting employers and employees during that act, and it'll happen next year. So we want to do a webinar calling out some of those impacts and some of the key items and issues that you need to be aware of as a business owner. So be on the lookout for that as well. First, here's our informational page. It contains our legal disclosures for your convenience. Also, I urge you to always be checking out our OneAZwealth.com website for any upcoming webinars, as well as future information and topics. Now, for better audio, this webinar today will only be in a listen-only mode. Now, we will be fielding questions at the end of the webinar, so I urge you to email in your questions to oneazwealth@oneazcu.com. Now, we're compiling those questions, and we're going to answer those at the end of today's presentation. And if we don't have time and we don't get to your question, I want you to know we will be following up with you individually and directly. Now, also, we received a number of questions already for tonight, so I'm excited. We're going to have some great conversations during the Q&A. Lastly, for again, more information about OneAZ Wealth, I urge you to check out our website. You can use the QR code that's on the screen right now. If you have your mobile device, you can scan that code. It'll take you right to our website. And then I also urge you to connect with us on your social media platforms. We've got Facebook, LinkedIn, as well as YouTube, and we provide good content and information on those sources. All right. So as I selected this topic, or actually this topic was selected by you, the viewers, I wanted to pull in one of my colleagues, somebody that I respect in this industry. His name is Neil Patel. He's a CPA. Neil has his own firm called Patel Advisory Group, and he specializes in working with small and medium-sized businesses and their owners. Excuse me. He is a graduate of the Chicago esteemed Loyola University and has worked for public and private enterprises during his career, really giving him great insights and experience with finance and operations, business management functions, etc., actually across multiple different industries. Now, Neil actually launched his own accounting and consulting practice in 1999. So actually for nearly 25 years, he's been advising hundreds of diverse businesses. As a result, he understands firsthand the challenges and opportunities that business leaders face today. Now, one thing I love about Neil is he has a personal mission statement, and I'd like to read the personal mission statement here. And that is, his goal is to help business leaders achieve their goals, reduce their stress, and find professional and personal fulfillment. I love that. I love that, Neil. So, Neil, are you there on the line?
I am. How are you, Tom?
I'm doing great. Great, great. So we did such a lot of fun in our lunchtime webinar. I'm looking forward to today's and kind of covering the topics again. All right. All right, let's get started. Well, welcome. I want to thank everybody that's joining us today. We're going to cover a number of things, and I thought I'd just kind of highlight a couple thoughts that come up on some of our initial research in this area. We've discovered there's lots of myths, and there's also some falsalities and people's realities on strategies sometimes are a little off when it comes to succession planning. So we want to straighten those out and provide some clarity there. Let me share this. When we did the research, we found out there is millions of small businesses in the US. And these businesses range from the self-employed professionals to medium-sized firms and also large manufacturing firms as well. But small business actually employs about 55% of all US workers across all geographic areas. Their success, or I should say your success, if you're one of these business owners, your success is helping drive America's success. And we know that, and we thank you for that. Now, we also know that more than half, that's right, half or more of today's small businesses are owned by individuals that are 50 years or older. And 23% of those businesses are actually planning on selling or transferring their business in the next 3 to 5 years. Now, we also have got some research that's indicated about 38%, that's about a little more than a third, but about a third actually have a formal business succession plan in place. And we want to make sure the other 2/3, which many of us on this call might be, those 2/3 are also addressed, and we can help you get your business succession plan started. Now, we also know that about 40% of those that have a plan actually have it funded, or a plan to fund the purchase of the business or a strategy for the business. So that's critically an important critical call out as well. There's 40% actually have some funded planning done. So I'd like to see that in a much bigger number. Well, all right, let's get started, because I want to get into what is a succession plan, things to consider as well, and then how do we really get started. So let's get started. Let me highlight the agenda. First, we're going to go over some facts and stats and some common misconceptions about succession planning that we see each and every day when we're calling and talking to clients. We will also be reviewing key questions to ask yourself. You need to be asking yourself in helping design your plan. Now, every business situation is different, and I know that, and each goal and everybody's expectations will be unique as well. But that's what's so critical, is you need to be looking at it and understanding, what questions do I ask myself? Also, there is a difference, and we like to make sure you know there's a difference between a succession plan and an emergency plan. We want to make sure you understand the difference there. All right. Also, once you've gained clarity on what's most important to you, then we're going to drive into some options and some strategies that you need to use or think about in accomplishing your goals. And with decision and indecision, I should say, because some of us don't make any decisions, so those are the indecision ones, come tax consequences. There's no way that we can avoid taxation entirely. However, there's great ways, and there's multiple ways to minimize it or better plan for it. So we want to go over that at a very high level tonight. Knowing the true value of one's business is critical. And wow, we hear this more and more. A lot of people don't know the value of their business, and we need to make sure you do have at least some valuation so that you can better start your planning process. And lastly, we end the program with some clear steps to start right now, as well as some Q&A at the end. So we got a lot to talk about, Neil. So let's kind of get started. All right, here's a chart I came across. It's from the corporate values metrics from 2021. The numbers haven't changed that much dramatically, but this is a real call out. If you take a look at the size of the markets, the micro market, that's when you have sales of under 5 million, you're looking at 5.5, almost 5.6 million companies in the United States. That's actually what? 93% of all businesses. So when I say the lifeblood of the country is on small business, we know that 93% is really the driving force here. And then if you're lucky enough to be in the mid-market where you're a little bit bigger, that 5 million to up to 100 million, you represent another 6.5% of the market overall. But we do know, we recognize that the lifeblood of our industry and what's driving the economy many times right here is in our small business market. Some other facts and stats that I came across as we kind of put this program together is, take a look, 51% of privately held companies are owned by baby boomers. Baby boomers, yes. I know baby boomers well because I am one, as they say. But looky here, baby boomers, they're between the ages of 59 and 77 years old today. And look, in the year 2030, all the baby boomers will be 65 or older, all of them. So there's a huge wave of transition of a lot of these older business owners that are transitioning and want to sell or gift or do something with their business. And we need to talk business succession planning. I do know this is an interesting statistic, is when you turn about age 63 is when you start thinking about it. So the earlier the better, the earlier the better. So where's the rest of the businesses? Well, here you go. 46% are owned by people in the younger brackets. That's that age 36 to 56 years of age is in that category. So really the bulk is in the older market as well as in the baby boomer. And we know that's a huge market for transitions. All right, let's talk about some of these stats too that were quite amazing to me. 80% of an owner's wealth is locked up in their business. Now, that's not a shocking number to me because I see that. But I wanted you to understand, if you know and you feel that too, you're not alone, right? We know that a lot of that is your sweat and your equity and the hard work you've poured in. You've built up a company, and that company is you, and your assets is the bulk there for your enjoyment later in your life. So it's so very critically important to recognize if 80% of our assets are tied up in our own business, we've got to make sure we transition it or sell it or find a succession strategy for it in the optimal way, in a very optimal way. Another thing I call out here is 50% of business transactions are involuntary. What does involuntary mean? Well, you didn't really pick the choice to make that happen. Involuntary, and I'll list a few down here. I call it the 5 Ds. One is death, you've got disability, you've got divorce, you've got distress, as well as disagreement. These are the 5 Ds, and you got to be aware that these do impact 50% of businesses. So does your succession plan, if you have one, does it take care of, or does it even talk about or address these 5 Ds? Critically important to think about. Then the last one, which is also a very important call out, and I'm going to ask Neil to come on here, because 75% of owners regret selling after their first year. Wow. When I learned that statistic from the Exit Planning Institute, who does this and does these surveys of business owners, I was quite appalled and actually quite shocked to see that number that high. But after I learned the background of it and understood what happens many times, it made more sense. But go ahead, Neil, what did you want to share on that?
No, I would say that that's an accurate percentage from what we've seen with some of our clients, based on, various components of planning. There's a little bit of seller's remorse. What does my life look like now, that which was my purpose for all these decades is now gone. There's also sometimes feelings that they could have struck a better deal. It usually comes after the ink has dried on the transaction. And others, sometimes have concerns about the terms of the deal on getting paid back and getting paid out properly and so on and so forth. So it all, I think, in our experience, has come down to the planning of that amplifies these regrets.
Yeah, you're right. I think the thing that I saw in this study is that part of that 75 is people got rushed into making a sale, and then they have the regrets for making it because they didn't properly plan ahead of time, right? And
Yes.
they just need to plan ahead, because there's so many little variations and scenarios you need to be thinking about, depending upon the scope of your business and family members, et cetera, and et cetera. It's just not an easy decision to make. You've spent a lifetime sometimes growing your business. You need to spend a little more than a few days making a decision to sell. So you really need to be proactive in that regard. So let me talk about some of the top 5 misconceptions that we see. The first myth that we see is, oh, we have plenty of time to plan. Well, I don't know about you, but I know time goes faster and faster as I get busier and busier. And this is a common thought that we all as business owners have, that guess what? There's always tomorrow. Well, no, there might not be. And planning cannot wait. You need to do it sooner versus later. So please do it sooner, because, you know, if you wait too late, it really creates financial stresses and well-being on you, but also the family, as well as the business itself. You may be putting it in jeopardy. You need to make sure you're selling it at the right time, at the optimal time. So please plan ahead and start thinking about that. So myth number 2, what do you say, Nick or Neil?
I think that, you know, there's a common, I think, misconception that there is going to be a ready, willing, and able buyer who's going to show up on your doorstep with a briefcase full of money, ready to just buy your business from you. And in my experience, that has not happened. There have been unsolicited buyers, but it's kind of luck of the draw, not something to hang your hat on. There's also maybe some confusion around alignment and value in what you think your business is worth to what you might get for it in the market. And there's also a little underestimation, I think, of how much work it actually takes to get your business ready for sale. There is a certain amount of, you know, due diligence and pre-work that should be considered. So just putting it up on the market might be something that sounds good, but it generally doesn't turn out for the best financial outcome.
True. You know, you're right. Sometimes the deals, if it sounds too good to be true, it probably is. And that's what happens sometimes on business transactions that happen too quickly, because people need to be really thoughtful in the process on both sides of the equation, the buyer and the seller. Myth number 3, my successor or my kids, well, they'll be ready when I'm ready. Well, I'll tell you, I see this from time to time, where really a business owner thinking the kids are just going to step up and run the business. Well, you know, handling a business is a difficult process, and the odds of success go exponentially up when preparing that successor management ahead of time, and really having conversation and dealings with family members, if that's going to be the case. One thing I'll call out, and I'm going to be brutally honest to those, I know many people think my kids or my family will take over this business. Well, if family members are going to be involved, here's what I have to say. You must, and I urge that word must, be clear and have open discussions in advance, and truly recognize each individual person for their strengths and their weaknesses, because this can be a real misconception. People think, oh, my son will handle it, or my daughter will handle it, or whoever, a family member may take over and do it the way I do it, and they'll know it. They may not. And you have to understand that and be prepared for that and walk through that process. So a key call out there. How about number 4, Neil?
Equal is synonymous with fair. There's I think this generally applies in the context of a family, you know, transition to family members or whatnot. Parents who want to be equitable in dividing up this large asset equally amongst their kids. That sounds good on paper, generally very difficult to facilitate. And fair, you know, really should be considered in the context of clarity, fit and business continuity. Perhaps not all of your kids want to be involved in the business. They just want the asset, their portion of their inheritance from it, and they don't really want to be involved in the day-to-day management, nor are capable of that. So there's ways to structure that in a way that is equitable without being equal.
That's so true. I have twin daughters, and I know I try to be equal with them. But I'm not. But they do know this, and they know they're loved, and they know mom and dad are going to treat them fairly. And they understand fair is important. And that's all we're trying to call out here, right? It's just, we want to make sure they understand you're going to do the very best, whatever your business model is, but recognize equal doesn't necessarily mean fair.
Correct.
Yep. Now, myth number 5, while giving up ownership means, well, I'm going to lose control or I'm going to lose my money. Well, this is a common error or common fear that business owners have, and what happens is that prevents them from taking action. Well, listen, ownership can easily be separated from control and also from cash flow. So listen, it's so critically important that in a transition planning process, you can actually do transitions but still have income, or keep ownership control, or keep some voting rights. All of that is critically important. So whatever your desires are, you need to be thinking about them as you go into this process so that we can address them. Now, one thing I want to also say is this whole thing about income. I hear this frequently, and one thing we can do and talk to you about is that recharacterization of what income is. There's income that we pay taxes on, like ordinary taxes, and then there can be income that can generate what we call a capital gain income, which capital gain income is actually taxed at a lower rate. So again, it's all part of the planning process of how you build out your transition and make sure your income needs as well as your ownership transition works around what your goals are. Speaking of business and transition plans, here are 4 benefits I just wanted to call out that I see in having a good business succession plan. And some of these are going to be repetitive, but it's worth calling them out again. The benefit of a good plan is going to create orderly transition for both the ownership as well as for the management and the staff. You need to make sure the business can continue, because poor management and the transition can have a real negative effect on business results, and in some cases even result in a business failure. The number 2 is minimizing the potential conflicts that can happen between heirs and other business partners. If your hope is to have your business continue by one or more of your family members, please coordinate your succession plan with your estate plan. It will also be important to consider the tax consequences as well. And 3, provide economic support for you and your family. Well, the value of your business will represent a substantial source of income during your retirement life. See, when you're retired, I call this the Saturday, every day's a Saturday. So when you're retired, you hope that you're going to have enjoyment during those everyday Saturdays. So it's critically important to recognize you plan it out so that you can have a smoother transition in that process. And then you have to always be thinking about the involuntary transitions, like what happens if I pass away or become disabled? How is that going to affect my spouse or my loved ones that I leave behind? How will that income or the benefit from the business, how will that help them? And consider ways for those contingencies. Again, those are important steps to take now, years before the transition is going to happen, because you want to maximize the value, really maximize that value of the business. Now, also on the succession plan, here are some of the need tos, and I have them listed here. I call them need tos. The need tos are: 1, you need to recognize industry norms and the unique qualities of your business. Even geographically, a business can take on totally different valuations and how it's run and how it's managed. Clearly, industry norms are important. You need to understand them, but you also have to understand some of those unique qualities as well. Now the second item there is identifying the risks that can impact the value of your business. Now, what am I talking about impact values? I'm talking about things like seasonal sale demands, right? Things might go seasonal on you, or special pricing contracts that you might have with vendors, or contracts that may be coming up or may be changing in the near term. Here's one I see occasionally is labor contracts or labor agreements. Where does the labor agreement stand today, and where will it be in 2 years from now? And being a buyer, you need to understand some of these risks as you're looking at being a proactive buyer in any of these agreements as well. The third item here is fully understand both sides of the transaction. I mean, it has to be a win-win if you can. Make it as best as you can a win-win. Both the buyer and the seller need to feel they won. You need to take into account everybody's needs and desires as you're building out that succession plan. The last bullet point here, as I've listed, is just trying to minimize that tax liability, right? We talked about the erosion of your business valuation. With proper planning, such as tax costs, can really impact what you'll enjoy and take back and have for your retirement, as well as be able to pass along in your family for generations to go. Now, not on the list, I'll mention this one. This is on the list, but here's a little bonus one. I want to call out that in event of a death or a disability, I really know this is a critical area that you need to think about and address. If you're going to become disabled, if there's a death of you or your partner or whatever it might be, that can really cause some business chaos. So I ask you to be proactive in that planning and think about the financial aspects and the financial protections that can be put in place during that time. All right, let's take a look at these. These are key questions. Now, don't worry, you don't have to write all these down or memorize them, but I'm going to let you know the copy of tonight's presentation is going to be available after we get it posted on our website. So then you can just pull this slide up and look at these questions yourself. But let me kind of go through and highlight some of these questions right now. I think I have about 9 of them listed here. So let me kind of go through them pretty quick. Number one, the most important place to start is, what is the value of your business? What is it really worth? Because that's going to help set the stage for all the planning that you do and we can help you with, right? You need to know where it stands today. What can we do to make it better? What things can we do to improve it or change? Now, the business owners usually will find them vastly underestimating or overestimating the true value of their business. And Neil's going to talk about this a little later, but you have to have a willing and enabled buyer to make a good business transaction. So that's the critical thing. What is the true market value? Is having all parties come to terms with what makes sense and will be a win-win for both parties. The next question I like to ask is, do you have a written plan in place? Because some people do. Actually, I found this in case. Sometimes it's embedded in your business operating agreement. Maybe you have a business operating agreement. If you have a business that's been around 20 years or so, that was a popular thing that they did, where they put it in the business operating agreements. And if it's in there, take a look at it. Does it say what you want it to say now? Does it need to be updated? Does it need to be changed? And will it meet the needs of what your family have today? So make sure you look and make sure you have a written plan. Another one is, when do I plan to exit? Well, there is no right answer for this. That's up to you. But it's important to start with a timeline and a strategy line and recognize it's important. Now, I mentioned this earlier, right? 1 out of 4 business owners, 1 out of 4 are planning to exit their business in the next 3 to 5 years. I mean, there's a huge wave coming. So let's get ready for it and get yourself ahead of the curve on this. Now, the next one, number 4, was, all business owners will exit their business someday, right? We know that. I want you to know that is what we call the involuntary or voluntary. And that involuntary aspect is what happens if something would go awry, a divorce, a disagreement with your business partners, and all of a sudden you have to break up. What do you have in place in those scenarios as well? 5 is if something were to happen today, like a death or a disability, have you identified a person who will be able to successfully step in and take things over and keep them going? I've seen this happen when if it's not set up properly, or have a plan, a contingency plan, if that happened. I had a good friend that was a dentist. He passed away. And fortunately, we had good strategies in place already that another dentist came over, took over the practice, and the business had the building as well. That was handled and that was cared for. So it was a win-win-win. And his wife and his daughters were able to continue to live out the life that he chose and wanted them to have. And they all ended up going to college as they desired. So it was a win-win-win. But that didn't just happen by accident. That takes time and that takes important planning. All right, so another call out, number 6 is, what do your business partners think, right? Hey, if you're in business with somebody, you better be on the same page. You better be talking about it. You better think about it, and you better have some real heart-to-heart conversations about thoughts on this matter. Number 7 is, what do you need for your family if something did happen to you? And I kind of mentioned that in the prior one there. If you did pass away on the business to the heirs, well, how's that going to impact the family that's left behind, right? Making sure you have some strategies in place there. Number 8 is advanced thinking and planning around, well, how much do I really need after I exit? Well, there you go. How much do you really need? Maybe it's not uncommon that somebody could retire and actually make a lot more money being retired than they would have ever still running their business. Or vice versa. Maybe you can't sell the business because you won't have enough to retire on. Well, you need to be thinking about that. And those are key questions. What do you really need after? Because I talked about that every day is a Saturday. Well, it's true. All right. Lastly is, what is your real motivation and why, right? The plan to address these personal questions. It's really important to address them. Why? Why do you want to sell? What is the motivation and what's causing you to take this action? Those are key call outs. All right, so let's go into the next stage, this how, the when, the who. Why don't you talk a little bit about this, Neil?
Absolutely. So but just to wrap up on the previous slide, just great key questions or stimulating questions to ask yourself to kind of start thinking about those things. They're very important. And they should be deliberately considered. So on this slide, I basically break this up into 2 sections. When you transfer a business, there could be an internal transfer, meaning you want the business to stay within the family, and you can transfer that either through gifts to your desired family members. It could transfer at death, or there could also be a sale of the business interest to a family member. On the right side, we have an external transfer where there's this transition that might occur with a key employee or your business partner, or there's a unsolicited third party that wants to come in and buy. You know, in certain cases that we work with clients, there were minority interests that were transferred to key employees in an effort to keep them, to retain them in the company, and also to see if this is ultimately the person that can take over the business in full and buy you out, sort of in a built-in succession plan. So definitely, you think about it from an internal perspective and an external perspective. If the internal perspective doesn't really fit your facts and circumstances, maybe the external component is the way to go, or vice versa.
Yeah.
Okay. Next slide. Taxes, always a hot topic when talking to business owners that are thinking about transitioning. Taxes are going to be the largest, if not one of the largest expenses that you're going to have on this transaction. And you want to be prepared about the financial consequences before they occur. There's multiple ways that a transaction could be taxed, depending on if you have an internal focus or an external focus of how you decide to transition. Unfortunately, taxes are a reality. Understanding how much and when this is going to hit will help you avoid surprises and cash flow issues. So let's quickly kind of go through what some of the tax hits could be. A capital gain could be from the sale of your business. That could be an internal transfer or an external transfer. And it essentially generally is a max capital gains tax rate of 20%. That's if you choose to sell a piece of it, all of it, so on and so forth. You'll be subject to capital gains tax. Gift tax arises generally when you want to transfer an internal transfer, possibly transfer or gift a portion or all of your business to your family members. This could be, now the exemption for 2024 for gifting is $13,600,000 for a single person, or up to $27 million if you're married. If you should pass, the business will become a part of your estate, provided that the value of the business doesn't exceed this gift tax valuation that I mentioned earlier. You won't have an estate tax or a death tax. If it does, you could have an additional death tax of 18% to 40%, depending on how, again, the business is structured, planned, and transitioned. If it's a consequence, or if it's a conscious decision that you've made to how you want to transition this business, could mean hundreds of thousands or millions of dollars in additional tax. Income shifting is another option, with possibly saying if you have a key employee and you want to bring this key employee on as an owner, but you want to maintain control of the business. It allows you to sort of try before you buy. Does this person really have the management chops or the leadership chops to take over the business, in full? Transferring a portion of the business to them is possible with you still retaining control. And there are vehicles and strategies to help you do this, and a proper business attorney and advisor can help you kind of structure or walk through those. The underlying fundamental theme of this is be proactive in your tax planning and in your business planning, because the financial consequences could be material. And Uncle Sam is not very forgiving in how you structure your deal. They will not advise after the fact that, if you had done it this way, you could save, hundreds of thousands of dollars. So the responsibility really rests on the business owner and their team to structure this properly. Okay. Yeah. Next slide.
Sure.
So what can you do now to prepare? And I think the non glamorous or answer is you really want to sit down and decide what it is that you want for yourself and your life post-retirement or post-sale, and what that timeline looks like. The second thing is understanding how your business is valued. Different businesses in different industries trade at different multiples and in different manners. If you have a perception about what your business is worth, but that perception doesn't align with how the market treats your business, you might not be very happy with the final answer. But getting the value of where you are now would be a good way to get that high-low range. And once you do, if you see some weaknesses, now's your chance. You have the time to implement some strategies and some solutions to address the weaknesses, maximize the strengths, capitalize on some of the opportunities to maximize the value of your business to meet your timeline. And when you create this plan, or strategy, don't just keep it in your mind. Reduce it to paper. Write things down. Write down what you want. Write down. You may not get exactly what you want, but write down what you want out of this for yourself, and write down how you think you want to go about doing it and when, and then maybe start to jot down what are some of the things that are getting in the way. What are some of the things that are coming up in your own thinking as you write things out? And I can assure you that some things will come up. The final point is in the situation of a partner type of a situation. You have a partner in your business. It's important to have tools or agreements that help mitigate the risk in the event of the 5 Ds that Tom mentioned earlier. If there's a death or a disability or a departure, that is not the time you want to really be taking on how do you divide up the assets. You really want to put the thought into that beforehand, when things are good, when people are in good health or in good spirits, and you're talking it out with your partner, hoping that it never comes to that. But there is a mechanism in place to protect both parties. Things happen in over the course of a life in business. Your business partner, there could be a sickness, there could be a divorce, there could be financial issues that they've encountered. You don't want those issues to become a crisis for your family. So having the agreement and working out the details, absolutely critical.
Absolutely, absolutely. And just to continue on this, I'll just call out a couple things to really be thinking about as well, is that involuntary experience of death or disability. Life insurance or disability insurance is a common method or a tool that you can use. Doesn't cure the common cold, but in many, many cases, it can be very effective because they actually have very attractive tax advantages as well if you structure it properly. Another thing is I talked about again, I can't dwell on this enough, and that's the post-sale life plan. What are you going to do after you sell the business? I mean, I've talked to business owners that have sold and they really have an emptiness in their heart, and they kind of go through this withdrawal process because who are they? What are they? The business was who they were. And you need to recognize there is a life after a business, and you can create that life and need to talk about that and figure that out, or at least start strategizing on that as well. The last thing clearly is always seek professional advice and guidance. And I can't, again, that's a critical area, and I'll just call out the next slide here right away. And that starts with you. You need to create a team. True planning is actually a team sport, I believe, because you need to have a good wealth advisor. You need to have a good business banker that can help you think through the lending, the cash flow needs of the company, perhaps. How are you going to manage the debt structures, etc.? You need to have a good business advisor like a CPA that understands the business side as well as the taxation of it, so that they can give you good guidance and structure, because that's what Neil does each and every day. And then the legal advisor. Wow, clearly an attorney that's knowledgeable on estate as well as business planning is critical. You need to be given good counsel and thought through the entire process. Now, you work with all of them, and you kind of coordinate with all of them, and you look for all of them to work together to come up with a good strategy overall for you to help you really achieve your long-term goals. Now, let me come back. Yeah.
I'm sorry, I just want to say on that last slide, it's really important. Each one of the people on this page look at your business or your financial life through a different lens. And no two will look at it the same way. Everybody will have a different perspective, and it's good to get those different perspectives to really build out, so they look at the transaction from all these different vantage points to help you get the best, to make the most of this asset, mitigate risk, and so on and so forth. I don't think somebody can be an expert in all these areas and adequately advise you. Pick your team carefully.
Yes, and they'll bounce good ideas around with strategies too, for sure. All right, so we're coming towards the end. I've got a few more slides, but here's one I wanted to go through: the top 10 reasons you should have your business valued. Now, some people are afraid to do it. Some people are afraid of the cost. Well, we can take care of that for you. And I'll talk about that in a minute. But the most important thing is you just need to get a value, an estimation so that you can begin some planning. But here are some of the top 12 reasons. I'm going to go through them kind of like the David Letterman list. So one was 98% of business owners don't know their value of their business. Well, that's not a shock, but you can. Let's get it started. Number two, better understand how your business or understand your business and its potential. Well, if you know where you are, then you know what you can maybe make it become. Also, know the value of the largest asset can also help in your retirement planning. Clearly, we need to know how big it is so that we can make sure you have enough for retirement. 4 is ensure the business and your family are properly protected. We just said 80% of your business is your asset. And if that went belly up, or if that had some a terrible calamity occur, that valuation could be devastated, and it would impact the family overall dramatically. So you got to make sure you have that protected. Having a good succession plan is 5. Number 6, pay. If you're a buyer now, you want to pay the right amount when you're buying the business. And number 7 goes right on the other side of that. Is if you're going to sell it, you want to make sure you're getting the right sale price. Number 8 is you want to create a buy-sell agreement with your business partners that are logical and fair. Number 9 is explore funding options. Well, how do you fund this, and how will you fund it? Number 10 is establish a trust or even create an estate plan. Do I need a trust? Should it be in a trust? All those are really good call outs and things to be talked about. Number 11, prepare for a taxable event. Like, for example, with gifting or grants. Should I gift? Should I grant? How do I do it? Do I even donate this maybe to a charity? There's all kinds of possibilities that we can help you with in that planning process. But the best one I like is the number 12. Number 12 is 82% of all business owners that if they knew, and the ones that did know their value of their business, actually, after 18 months before the sale, actually was able to increase their sale price by 14%. So what does that mean? Well, the proactive business owners that took an active role in knowing what their business was worth before they had to sell it or wanted to sell it, they had a chance to kind of clean up the shop, so to speak, put a new coat of wax on the machinery, etc., to make it look good and make it be good for you to sell for the next buyer to have the greatest value given for both. So that's a key call out. Really have that data ahead of time. Now, speaking about ahead of times, the first step is now. As I always say, the first step is now is always now. And it's so critically important to make that first step. And to help you, OneAZ Wealth Management, actually as part of our overall financial planning review, is now making available complimentary a business valuation estimation for our business owners that are members of the OneAZ Credit Union. We use a system called the BizEquity calculation tool. It's a phenomenal tool. It's a very good tool. It is not a certified appraisal, but it gives you some great valuation models and shows you the way calculations are made. And it also shares, and I'll be able to share with you, some areas of how to improve the value of your business. It's a nice report. It's about 25 pages long. So it's a great report. This report on the street goes for $2,500 or more, but we're making this available to our business owners and clients in a complimentary way because we know how critically important this first step is for you. So I really want you to take that first step. So we're running close on time, so let me jump right here to the Q&A session. We actually have approximately, well, we got about 7, 8 questions that have come in. Let me just kind of jump right into the questions. Are you ready, Neil?
Absolutely.
All right. The first question that came in here is, how do I transition my firm to a younger, up-and-coming engineer owner?
Well, I could take that.
All right, go for it.
So some ideas to consider. These aren't, all the facts and circumstances of everybody's situation is different, but something that you may want to consider is is offering this person a minority ownership in the company. Now, there's things that would need to be done with valuations and so on and so forth, but this would allow this person to kind of come in, take an ownership role, and step into an ownership position, and still allow you to maintain control of the business. This will give you the chance to see capabilities, and capacity, their ability to lead and grow. It can start to form a basis versus a sudden event of trying to sell all of it to somebody that may not be able to handle all of it.
Mm-hmm. Mm-hmm. That's a good call out. All right, number two, second question is, how much does the BizEquity charge for a business valuation? What is it? Well, the BizEquity charge, we are absorbing that. That's a system and a service that we own and subscribe to, and we're running those reports for our clients, and that's why they're complimentary to you. Next question is, how can I maximize the value of my business? How do I know when I should sell? There we go. You want to handle that one, Neil?
Sure. So, big question on how do I maximize the value of my business? The first thing that I would suggest that people do is take an assessment of your business, a kind of a snapshot of each component, operations, sales, business development, finance, and accounting, and get a state of affairs of kind of where things are at. Get the BizEquity valuation to find out what the baseline is. Okay. Use the assessment and then the baseline together to determine where you've got some weaknesses. There could be issues in product line, revenue, margins. It could be overhead. It could be a balance sheet that has too much leverage. There could be a variety of factors, excessive expenses in areas where things could be cut to improve profitability. All these areas they work together, and it's generally never a magic bullet. It implies understanding where you are, where the opportunities are, and then attacking kind of from the low-hanging fruit and moving your way up. How do you know when you should sell? That's a good question. That is very subjective and determined based on each individual owner's facts and circumstances, what their timeline looks like, what their after sale life looks like, what the dollars that they're going to need to support that after sale life. All of these things would help determine and help you formulate when to sell.
Yeah, good. All right, here's another one. Interested in what it takes to transition from a single member LLC to an employee-owned business. You want to touch that one as well?
Sure. So that it seems like that is alluding to an ESOP, an employee stock ownership program, in which the employees actually own the company through a trust. This is a company like Winco, if you've heard of that in the Valley, the grocery chain. That's an employee-owned company. There's certain facts and circumstances in which that works well, and then there's certain circumstances in which that doesn't work so well. It sounds good in terms of what it could do and what it could mean, but there are also formalities that need to be formed. It's basically, a trust. So what I would recommend for the person posing that question, give us a call, set up a time. I'd be happy to talk with you offline in more detail about that, as it could get a little complicated. Sure can, but it can be very effective tool for sure. Absolutely. In the right circumstances, it could be, I've seen it work with clients that we have. It has worked very well. Yeah. Here's a question. I've got a long time before I want to retire from my business. How far in advance should I start planning? Well, I think the sooner the better. Planning is critically important, and it may not be when you want to transition as it for a sale, but it's those involuntary issues that we talked about, the involuntary issues. Like I mentioned, I think I mentioned earlier, a dentist. My dentist client actually was 50 years of age when he dropped over with a heart attack swimming. And sure enough, that was not in the cards. That was not planned. However, good succession plan was in place.
and we were able to accomplish that. But it is important. The sooner you can kind of start your process, it's not always the retirement plan. It's also all those other scenarios. So my call out there is do it as soon as you can. Here's another question. This is a good one. Only one of our children works in our business, and the other two children have no interest. So I guess we have one child that works in the business, two do not. So there's 3 kids in total. All right. How do we treat them fairly in our estate plan? You want to handle that?
Sure. So it kind of going back to some of the other slides before, if one child has an interest and an aptitude and capability to kind of run the business, and the other two are the mom and dad want them to have their, I guess, part of their inheritance is the business, and the business value. There's different mechanisms that could be created, either through life insurance or buy-sell agreements for the son to buy the business, or allowing cash to be freed up to give to the other 2 siblings. And generally, in our experience, it's been that it's not that one sibling got the business. It's more about the other 2, in this case, not getting a piece of the pie. And their inheritance, and mom and dad feeling guilty about it, or it causing strife in the family as a result of it. So with planning and either funding through insurance or whatnot, there's a way for their value, in this case, 1/3 of the value of the business, being transferred to each of the kids by using these other vehicles. That only works when things are put in place early and things are thought about this way early, rather than it being a consequence.
So true. Again, that's that fair versus equal again. But it is important to think through that, of how we want to make sure the kids are treated the way you want them to be treated. Here's a question. I'll end with this one because I like this question, Neil, and I think I can handle it because I got a great illustration. My business doesn't really have value that can be sold down the road because I am the business. What can I do? Aha, great question. Love it. Well, that's all part of that pre-planning process. I used an example, an architect that I knew. He had his business and his practice. And just like we would think, right, if he died, what would happen? Nothing. The business is worthless. And what do you have? Some drafting table, maybe some pencils, some paper. I mean, what else is there? However, good counsel and good strategy planning with him, there was an encouragement where he would form and brought in 2 other business partners that also had architectural practices. They all collectively pulled together, and their firm actually grew exponential over the next 10 years. Over that process, they had 24 employees. Now they have a company. So guess what? When each one of those 3 main partners ended up selling or leaving, or one of them passed away, they all were able to get some value from the business. It became an ongoing concern. So that's a critical call out. How can I take my one-man band, so to speak, and make it an ongoing concern? Well, there's ways to do that, or there's ways you can share some private rights to the business, or copyrights, or whatever it might be. Each business can be different, and everyone can be viewed at a little slightly different, but it's critically important to be proactive and to have these kind of questions and these kind of dialogue. That's really good. Well, a lot of good questions. We've got more questions here, but we're running out of time. Again, I want to thank everybody that's been on the call. Let me just wrap it up here with a couple comments. First of all, I thank you, Neil. Truly, thank you for helping in today's presentation. I really appreciate it.
My pleasure. Thanks for allowing me to be here.
Absolutely. And you're a great resource for our wealth advisors also. So I'm excited to have you collaborate with us. Now, for those that are watching and listening, I want to thank you for joining. We hope our discussion today has actually helped you in providing some ideas on succession planning for you or for your business. A copy of this presentation will be posted on our website, as well as we will be reaching out to each and every one of you as a personal courtesy follow-up to address any questions that you had that we didn't get to. or just in general, what you thought of the webinar. You know, we always welcome your feedback and we're welcoming your comments. So please email us with any suggestions you have on future webinar topics, because that's what makes us get better and programs become what they are, is it's your feedback and your suggestions. As always, our entire OneAZ Wealth team of advisors stand ready, willing, and able to assist you in reviewing your current financial plan or even your investment portfolio in light of today's economy, right? We know there's no better time than at present for a second opinion. Now, many clients already have advisors, and I understand that when they first come to us. However, what they learn and they discover is some of these new ideas or strategies we can present, and then they're very interested in. So we welcome your call. So please call us at our 800 number, 877-566-0517, or you can visit us at the OneAZWealth.com website for more information about creating your own financial plan or your business succession plan and retirement plan. Again, thank you for joining us tonight. From all of us here at OneAZ Wealth, we want to wish you the very best for the remainder of 2023 for your safety, your health, and your wealth. Thank you and have a good night.